The biggest roadblock in investing, especially for early investors, is what do you invest in? And that roadblock can actually cause a lot of analysis paralysis, which really just means you overthink things, you don't make good decisions, you don't commit to an investment quickly enough and long term enough, and you often pull back from an investment only to realize a loss instead of holding out for the gain. And this is true with the stock market, this is true with real estate, this is true with businesses, this is true with almost anything, is you overanalyze and then you get scared and you make bad decisions. So I think the most important thing with investments is to have conviction about the thing you're investing in so that you can actually have a cooler head and actually invest smartly. And the only way to do that is to understand the elements of that investment. Like I have a friend who invests in Tesla. He knows every single aspect of how Tesla makes its decisions. He listens into all the investor calls, all the shareholder calls. He analyzes every single engineering document that's public on what they're doing, why they're doing it. He's putting the puzzle together of what the vision is for the future of the company beyond just what is available publicly. He's looking at it from an engineering perspective. Well, similarly, I think that it's important to understand real estate at that level because I'm a real estate investor. And if you are thinking about real estate investing, especially if you're in the military, you should listen up to every single one of the 6 points I'm about to make. And the last one is actually going to be one you probably never heard of. And I'm not saying it last because I want you to watch the whole video. I'm saying it last because after you understand the other 5, the 6th one will kind of come into perspective. It'll make more sense. And all of these 6 elements, when combined together, create this amazing multi-layered cake of profit for real estate investors. And so without further ado, let me go through all 6. And if this is your first time watching one of my videos on active duty passive income, we are a military real estate investing education community. And this is all we do. We talk about real estate investing, we invest in real estate, and we share each other's experiences so that we get more of the country we served, we own more of it, right? And we produce more income during and after the military. So here we go. The first part about real estate, the first layer of the cake, the first profit center, as I like to call it, is leverage. And what leverage means, it's just like a technical term for really having somebody else participate in something with you. So if you put in a certain amount of effort, somebody else puts in their amount of effort. This can be with people, like you can leverage team members to get a project done, right? In this case, it's money. You put in a certain amount and the bank or a lender or a private lender, somebody else puts in their money to acquire that property. That is what leverage is called. And if you're asking me like, wait a second, Markion, isn't that just debt? You're right, it is debt. However, with real estate, as long as it's good debt, and we'll get into that later, it's basically, let's think about it as leverage, because right now, here's the analogy I'm going to make to you. Remember we talked about Tesla earlier? Here's what leverage would be for Tesla. For Tesla, it would be, hey, I have $20,000 and I want to buy $20,000 worth of Tesla stock, as an example. Well, guess what? What if Tesla was like, hey, every $20,000 of our stock you buy, we're going to let you not only hold that $20,000 of stock as yours, we're also going to let you realize any gains, like any interest, right, growing in their stock, right, off of $100,000. So you put in $20,000, but they're going to let you receive the gains off of as if it was $100,000. Does that make sense? So you still only own the amount of shares that it cost you initially to buy the $20,000, but you're able to benefit from as if you had $100,000. Does that mean you then benefit? Then does that mean that you will have to soak up or take damage when the losses happen? Like if that 100,000 went down in value, yeah, right. Now your multiple of losses is greater, right? So that's where the risk is with leverage. However, if you understand the real estate market and you understand that it is always going to go up in the long term, as long as you do some basic taking care of your rental property, you'll realize that long term it's always going to go up for other reasons, like the last point I'm going to make later as well. And if you just hold out, leverage is the most powerful tool for real estate because it's one of the only things that other individuals will leverage with you that much that they'll let you borrow so much money. And that's a testament to how good of an investment it is, because everybody else knows that over time, real estate grows in value, right? There's only so much land on this earth, and there's only so much of America for us to have. And real estate is that most sought after thing here in America. It's a kind of like a part of our cloth almost, like owning a home, And so that's why, again, leverage. You put in 20%, for example, on a property, and the bank brings 80%. So basically, you bought an investment vehicle that's 5 times greater than the money you had to put in. So if it appreciates, let's say you bought a $100,000 home, you put in $20,000. Let's say that $100,000 home appreciated 10%. Guess what? You didn't make $2,000 off of your $20,000. You made $10,000 off your $20,000, which is really a 50% increase on your capital investment. So that is the power of leverage. Now, the second point I want to make is my favorite and our community's favorite, and that's cash flow. Cash flow is the second profit center. And what cash flow is it's the income you're going to make on a regular, consistent monthly basis. It is what you put in your pocket, net after all expenses. Because if you're a smart real estate investor, you don't want to have to pay for holding on to that asset. You want somebody else to pay for you to benefit from that asset. And so you buy a rental property where the renters, the rent that they pay covers the principal, interest, taxes, insurance, property management, maintenance, vacancies, and reserves. It covers all of that. And then after all of that, you not only break even, you maybe make some money too. A couple $100, maybe a couple $1,000 per property. But that way, owning that property is not only, awesome to see it growing in value and making you wealthy, but it's also making your lifestyle better every single month. So that's why we talk about cash flow so much, because as long as you get the cash flow piece right, everything falls into place. As long as owning the property isn't a burden on you monthly financially, it actually benefits you every single month, then it is the best investment in my opinion, because now you don't have to worry about it. It's not a liability, it's an asset. The second thing is appreciation. We talked about this with leverage quite a bit, where how over time property grows in value, and this is true. And so when you combine appreciation with leverage, it mitigates the risk of that leverage, like I mentioned, but also just realize that is absolutely true. Look at the long term for real estate, and over the long term, just like if you're thinking about investing in a 401k, Roth IRA, TSP, whatever, over the long term, you trust that it'll grow in value. And so that's the same thing with real estate. So if you're okay with holding on to real estate, similarly to like a retirement fund, this is a similar mindset or concept, okay? This fourth thing, okay? Point number 4, profit center number 4, appreciation was 3, is tax benefits. Now, this is sometimes understated, and it is one of the greatest additions to the returns you get from real estate that just is difficult to calculate, but because a lot of times in the military, we accept that the paycheck we get is what it is, and we almost don't even look at the withholdings. But the reality is you pay a lot of taxes. And imagine a life where you wouldn't have to pay those taxes. And so in real estate cash flow, which was profit center number 2, typically you don't have to pay taxes unless you sell the property. But then there's even mechanisms to how to defer those taxes further until you pass away, and then that tax liability just disappears. And so real estate has all these really cool mechanisms, but the reason why you don't have to necessarily pay taxes on the cash flow, or maybe little to no taxes, is because of this magical thing called depreciation. And depreciation is basically just where the government determined that real estate loses value over time, over 27 and a half years. And it's not based off of when the property was built. It was based off of when you acquired it. And so that 27 and a half years is basically like, if you're familiar with a write-off, right? You make certain money with your business, then there's a business expense. Now you get to write that off of your income. You don't have to pay taxes on that portion of the income that you wrote off. So this is similar, except for that write-off happens over an extended period of time, which is 27 and a half years. And so you get to take a little chunk of your property's value as a write-off against the income it produces. So here you are, you're bringing in revenue, right? And so you get to write off most of those expenses, and then you also get to write off this phantom expense that you don't see. You don't actually have to pay for that expense. It's just the government considers it happening. And so you still put money in your pocket with the cash flow, but that cash flow isn't taxed. And then sometimes it might get to the point where you have so much depreciation, it's actually wiping out completely your cash flow, like tax liability, and then you're still in a loss. And you get to count that against other income. Now, I have other lessons that talk about that, but that is where it gets really crazy and really exciting, because now you're potentially able to not pay taxes on other income. So real estate benefits you more than just on its own income, but it bleeds over into other places as well. The fifth profit center. Okay, guys, so I hope you're sticking around, because we're about to go through this one and then the ultimate one, the sixth one, which will kind of wrap it all together. And this one is principal paydown, which, don't get confused by that term. Really, all it means is people pay off the debt for you, okay? It's kind of like a reverse savings account. Let's say I have a certain amount of debt, but it's off of a thing that's worth something. Let's say it's a car. Let's try to give an analogy. Let's say you have a $20,000 car, you have debt on it. When it's paid off, assuming the value doesn't change, you now have a $20,000 thing. It's an asset, because if you sold it, you could get $20,000 for it, right? So you're now $20,000 wealthier effectively. Well, what if you didn't have to pay off that car? It's the same thing with real estate. What if you didn't have to pay off that property? What if somebody else did that for you? Well, that's exactly what happens with rental real estate, and you have renters. They are paying you rent, and then you pay that principal and interest on the mortgage. The taxes, insurance, property management, vacancies, reserves, maintenance, all that stuff is also paid. And that's principal paydown, because if you have multiple properties, what happens is you have multiple people working, living their lives and paying off a loan in your name, making you richer in your sleep. That is incredible. So basically there's this divergence with appreciation and principal paydown. Your property over time is growing in value, and the amount you owe on it is going down in value. And so that delta is growing in both directions. That delta meaning the difference. So your equity, your wealth is growing like massively. It's not only because of how the appreciation is going up, it's because somebody's also paying off that debt. And so your wealth is just off to the races. And especially if you multiply that by multiple properties, that's where the magic really happens. And this leads us to point 6. Point 6 is pretty crazy. And you hear about this with crypto a lot these days, but what it is hedging against inflation. And in the simplest terms, like, I'm not going to get into some technical babble, but we're going to go over some really simple concepts here, okay? And there's 2 ways that real estate hedges against inflation. The first and easiest one will just be appreciation and inflation. So essentially, what is happening with the dollar every single year, right? Presumably it's losing value. The last couple of years, it lost more value than we have seen in a very long time. And so what that means is if the real estate doesn't lose value, then the dollar, right, you need to have more of those dollars to trade for the real estate. And so if you lock in a certain price tag on the real estate for 30 years, meaning you bought it for a certain price, there's a certain amount of debt on it, and that's what you're working off of now for 30 years, and you're making those payments every single month for 30 years, guess what? Those dollars that you have to pay on that mortgage are getting less and less and less and less and less and less value, right? So rents and prices across the board in the country are going to continue going up, but you've captured that price. And so if you think about the appreciation piece, if you ever want to sell the property, maybe 10 years down the road, 15, 20, 30 years down the road, because more and more dollars are getting printed, the supply of those dollars is growing. So even if the demand stays the same, the overall value of the dollar bill is going down, because it's all a ratio between demand and supply and demand, right? And since the supply is growing, or the stock to flow ratio, that dollar is lowering in value. So you're going to have to trade more of it for the property. Well, that property had a debt on it that locked in the price for 30 years. And so you're able to ride that wave. And then the second way is rent. Because inflation happens across the board, you have to trade more dollars to rent a place. And so your rents are going to go up if you're renting out your property over time. And as long as you also buy it, here's another caveat, you have to buy it in a good market, right? Same with appreciation, where the demand there is growing or stable, like job and population growth is stable. And so with rents going up, what that means is now, again, most of your expenses are pretty much the same. Your principal and interest, if it's a fixed rate interest rate, it's going to stay the same for 30 years or whatever your loan is. The other expenses like property taxes, some of the insurance, maintenance, maybe all that kind of stuff will experience inflation, right? But those will not impact you as much negatively as the rent will impact you positively. So most of that will trickle down to your bottom line and into your pocket, and so it'll increase your cash flow. And so you're basically giving yourself a pay raise every single month. Similar to in the military, every single year when we have cost of living increases for our paychecks, right? 2, 3, 4, 5%, whatever it is. Same thing here. You're giving yourself a pay bump every single year, most of the time, right? Market dependent. I can't guarantee anything, but if you buy smartly, you should be able to increase your rents incrementally year over year. And so that's how you're hedging against inflation in two different ways. The property's growing in value because, well, maybe not in value, the property's growing in price because even if the value is stable, if the value of the dollar goes down, you need more dollars to trade for it. So then you'll be able to sell it for a higher price down the road. So you're always beating inflation that way. And then rents are going up even though your mortgage payments are flat for 30 years. And so you're able to get more money in your pocket every single month, year over year, right? Because the rents are growing up. So that is the 6 profit centers. And if that doesn't give you conviction that real estate, for example, is the way to go, I don't know what will. And again, whatever your investment vehicle is, I just think you need to be smart about it. I think you should learn as much about it as possible. You should become a student of your craft, a student of your investment vehicle, and really learn the ins and outs of it, whether it's Tesla stock or whether it's real estate investing. But at Active Duty Passive Income, the cornerstone of what we invest in is real estate. And we believe everything else can be built off of that. And that's how you truly create massive wealth. That's the common military family's way of achieving millionaire status or multi-millionaire status, right? So without not further ado, that's about it. I don't know what I'm saying now. This is Mark Yancich with Active Duty Passive Income. If you found this video valuable, please like and subscribe. Please share it with your family and friends, and I'll see you guys in the next video.